Hi everyone, my name is Stephanie Weke and I will be presenting on limited liability companies, otherwise known as LLCs. I want to start with a big picture overview of an LLC. An LLC is a hybrid business entity that combines a tax structure of general partnerships and the limited liability protection of corporations. There are several benefits of forming an LLC. The first is that you can elect for pass-through taxation, like what Sam and Ricardo covered earlier. I'll go into some detail later in the presentation about the implications of pass-through taxation for LLCs. Another benefit is that owners of an LLC have limited liability. This means that the LLC is a separate entity from its owner, and therefore it's the entity itself that's liable for the debts and obligations of the company, not the owner. Another benefit is reduced regulation. This means that there's tremendous freedom to contract for exactly how you want the LLC to operate. Because of this massive ability to contract, it can also be a big disadvantage since there aren't as many statutes and case law governing LLCs as there are for corporations and partnerships. Although there can be high transaction costs associated with creating an LLC company agreement, seeking professional legal counsel will pay off in the long run. LLCs have two primary ways of being managed, by members or through managers. Member-managed LLCs are LLCs where all the owners directly participate in managing the company. This resembles a general partnership management structure. Manager-managed LLCs are LLCs where a group of people are elected to directly manage the company. This management structure resembles a corporation with a board of directors. You're probably wondering how to decide what management structure works for you. Here are 5 things you should consider. One is outside investors. If some owners want to be more passive in management, then I encourage you to consider a manager-managed structure. Number 2 is size. If you have a large company with multiple members and shareholders, you may want to consider having a manager-managed LLC because it can be harder to make decisions with more members. Number 3 is authority. If you want to take part in the daily operations of the company, then member management may be more ideal. Members have voting power and can legally bind the company in transactions like checks, contracts, etc. Number 4 is operating agreement. This can be more complicated and robust with more members and therefore a larger company. Operating agreements are important because they specify things like voting rights, dissolution, capital contributions, etc. But this is where hiring a lawyer comes in handy because a lawyer can reflect your company's needs in a written agreement, which helps with certainty and conflict resolution. Number 5 is owners and employees. Depending on how active you or your owners plan to be in the daily management of the business, then hiring employees is something to consider in choosing member management or manager management. Member management structure is best suited for owners who want to be fully active in selling, creating, and dealing with their products. There are several ways to go about taxing your LLC. If you're a single member LLC, you will be taxed like a regular individual. But if you're a multi-member LLC, you will be taxed like a partnership, which means the company itself doesn't actually pay taxes. Instead, you as the owner report the profits as income on your personal tax return and are responsible for self-employment taxes. The pro is that you don't have to pay a federal income tax at the entity level, but the disadvantage of this is that you have to file a partnership tax return and pay personal income tax in proportion to your ownership interests. S Corps and C Corps are also different ways to tax your LLC. There isn't an LLC classification in the IRS, so C Corp and S Corp are just different tax characterizations, but they are not business entity types. A C Corp is the same thing as a corporation, and if you are taxed as a corporation, you file a corporate tax return plus a tax on dividends that are distributed. This is known as a double taxation of dividends. But if you're taxed as an S Corp, then income tax is not paid by your company, but rather you as the owner pay the tax on the company's profits on your personal tax return, regardless of whether the profits are distributed to the owners. This is similar to a partnership income tax status, except a portion of the income is treated as salary and a portion is treated as an investment return. Like the table reflects, there are different requirements of electing to be an S Corp or C Corp For example, S corps are usually for smaller companies, so you can't have more than 100 shareholders, whereas C corps, you can have multiple stock classes and the shareholders can be placed on a hierarchy. A series LLC is a fairly new business concept. It's basically an umbrella LLC that contains separate series, which are like separate cells for liability purposes. There's only one LLC, and each series within the LLC has its own assets and its own members and is liable for its own debts and obligations. This concept is so new that only some states allow for formation, like Delaware and Texas do, but not California or New York. There are different business types where a series LLC would be useful and beneficial. For example, if you had a property management company with several properties, each property would be a series under the master LLC. There are some benefits of using a series LLC. It has a low startup cost because one filing fee is required. You can protect your assets since each series acts like a liability shield, and it helps to mitigate your risk of business, and it's pretty flexible. On the other hand, there are some pitfalls of using a series LLC. The startup cost is kind of deceptively low because you must maintain separate bank accounts and accounting practices, which means the administration can be more tedious. And because it's so new, there are many unanswered questions about resolving certain conflicts in court. Lastly, series LLCs may not work across state lines because not all states have adopted this business entity type. Professional entities are special entities formed by people with a Texas licensed professional service, meaning you must obtain the license first before providing the service. This includes people like architects, lawyers, CPA, dentists, doctors, etc. Only licensed professionals can form a PLLC. Texas gives some licensed professions a choice of which type of entity to form, but other states don't always have this choice. For a PLLC, you can elect to be taxed as a disregarded entity, a partnership, or an S corp. However, members can only be those with the same professional license, and this is the biggest difference between a PLLC and a regular LLC. However, the same liability protections still remain. And for a professional corporation, the only difference from a PLLC is which licensed professional can form either one. So you can have an accountant that can form both, but sometimes radiologists can only form a PC depending on the state that you're in. The process of forming an LLC is fairly simple and can be broken down into 5 steps. First, you choose a name and you check on the Secretary of State website to see if it's available. Next, you appoint a registered agent. The Secretary of State website has some guidance on this, but a registered agent can be a member of your LLC and that person must sign a form of consent. Thirdly, you need to file a certificate of formation with the Secretary of State. This process costs $300. I know COVID-19 is affecting many things at the moment, but the Secretary of State is still open and is conducting all of its services online. So if you're ready to take that step, you can. Fourth, you should seek out legal counsel to help you draft an operating agreement that reflects your company's needs. Lastly, you apply for an employee identification number, which is used for things like hiring employees and filing a tax return. And that's it. It's a pretty simple process. As I mentioned earlier, an operating agreement sets a written understanding of how the company is to be managed and operated and is very flexible to write. Most operating agreements have sections including tax implications, new members, transactions, management structure, capital contributions, and more. Each provision is customized to the business.